So we're talking earnings. I want to run down some of the earnings data from our data team. Earnings are more than 6% lower year over year, but also beating those lowered expectations by 6%. What does that tell you about the quality of the rally we've seen so far? What insight does that give you about the second half?
Well, there's certainly a disconnect between what you see with earnings and what the stock prices reflect. The estimates don't really aren't meaningful to me. If I said I could run a 10-minute mile and I did it in 9 minutes, it just means I walk really fast. So there's a disconnect when you look at the earnings. When you look at some of the other data, it's not very good. Some of that can be associated with the 401k flows. 38% of the S&P 500 right now are in 7 stocks. So when people put money into their 401k, it's being concentrated, and that's about 80-90% of the rally so far are these 7 stocks. So the question is, how sustainable is this? And my counsel would be, if you're a younger investor, you're not so much worried about what might happen in the next 6 months or a year. But if you have a shorter time horizon, in fact, Fidelity just said 37% of baby boomers have too much invested in stocks. You should be concerned about a reversion to the mean and the data being reflected in the stock prices.
Okay. I mean, I know you've been bullish on short-term treasuries, and you've been a bit bearish on the markets overall. So I want to bounce something else off of you. So the Fed's quarterly senior loan officer survey, it's out this afternoon. The Fed got an early look at the data. Jay Powell said last week it shows banks were more hesitant to loan money in the second quarter than they were in the first quarter. So do you believe the Fed will see this as having the same impact as a hike?
I think so. I'm not sure that I'd follow the Fed when I'm making projections on what the market's going to do. But if you think about it, consumer credit card delinquencies are the highest they've been since the global financial crisis. You're seeing the 2-year average of foreclosures and bankruptcies go parabolic. So, it's consistent with what we're seeing in other areas with respect to the data. So I do think that's a bearish sign. And don't forget, you mentioned that oil prices are going up. Commodities index, the CRB, is up 10% since June. That means the Fed might actually continue to raise rates into an economic slowdown.
All right, that's an interesting take right there. So it's clear you don't have a lot of faith in this rally continuing in the second half. So if you don't have faith in the second half, where are you putting your money? Do you feel confident in any area of the stock market to put money into right now?
Well, sure. I think if you look at emerging economies like Japan, their GDP growth is rising on a year-over-year basis. That's a place to be. But I don't think that there's any reason to be upset with singles and doubles. I mean, if you look at gold, which I've talked about a lot, that's up 7% for the year. If we're at a place where getting 7% before August is a bad investment with low volatility, that speaks to where we are with respect to the market. I think singles and doubles for people who are closer to retirement is actually a good move right now. It's good to be defensive. Risk tends to happen in clusters. And so I would avoid the drawdowns and try and get nice, slow, steady returns.
So do you still feel the same way about short-term treasuries? That's where you'd put money in at least until later on this year?
Sure, you can get 5% in the money market fund with no volatility. That's a great place to be right now. So if you've got 40% in stocks and 10-15% in defensive things like gold and quite a bit in money market funds, you're still doing well.
Okay.
You're still double-digit
singles
returns.
and doubles, Ivory. Singles and doubles. That's the philosophy right there.